As we know, Canada's real estate market has been a hot investment, and with the recent changes to the TSX subsectors, real estate could get a boost in investor interest in the public markets. Let's get some perspective right now on what investors need to know about the impact of these changes. Joining us now is Andrew Moffs. He's the Senior Vice President and Portfolio Manager at Vision Capital. Andrew, let's first talk about what these changes are.
Right. So beginning this month, S&P broke out real estate into its own industry classification under what's called GICS. Up until now, real estate had been housed in financials. What does this mean? So now there's 11 industry groups. If you're a generalist mutual fund manager globally, you are benchmarked and you're indexed against different sectors. Real estate has now become a standalone sector. So up until now, if you had a weighting in financials, you might have hid out in banks or insurance companies and ignored REITs and real estate companies. The buying power is pretty robust for these mutual funds to become market weight alone in real estate.
What have we actually seen?
So this is different than a typical index ad where you immediately see a big boost to stocks. It's been a gradual move. It's been a very big move so far this year. If you actually look at numbers, there's been studies that show you could see buying power of $100 billion in the United States, 75 billion euros in Europe, even here in Canada, $10 billion Canadian to go into REITs just for these managers to get market weight.
Okay, and your firm, interestingly, focuses strictly on buying real estate, publicly traded real estate companies.
Correct.
So I would think that this has got to be a real positive for you and your team in knowing kind of, well, number one, you know that the money's going to flow into the sector.
Sure, yeah.
And then just really choosing the ones that people might even want to go overweight in.
Correct. Obviously, it's a good thing. When you see money flows come into a sector, liquidity improves. That makes our ability as traders that much greater. But in the short term, what you see is, I mentioned big dollar amounts. What happens? Money gravitates to sectors and stocks that almost indiscriminately. We are almost like private equity buyers in the public markets. So we focus exclusively on net asset value, whereas I'd argue most investors look at yield. They treat real estate as a yield play. That makes money go to those companies that perhaps don't have the best fundamentals. So that's something we can take advantage of. We go both long and short, and some of those sectors, like, for example, office, retail, where we're fundamentally bearish, it's an opportunity for us to take a short bet when these stocks go past their net asset value.
So you're bearish on office and retail REITs? Why?
For us, supply and demand fundamentals. That's where we spend our time. And then we focus on net asset value once we've done that. You look at office. There's both a secular change and a cyclical change. Secular is pretty interesting. We all use less and less office space today. Probably 15 years ago, we were using 250 square feet per worker. Today, open concepts are the norm. There aren't any law libraries, so that number is driven down substantially. So now we're going through a cycle where law firms, accounting firms are taking less and less space, despite the fact they're remaining in place. From a cyclical perspective, where we have concerns about the Canadian economy, and you're seeing that obviously in Alberta, for example. It's making it tough for operators out there.
So Andrew, you and your team cover REITs, publicly traded REITs in Canada and the United States. So you going bearish on office and retail, that's Canadian specific?
It is specific here in Canada, so our positions are in Canada. We do have positions on the long side on both sides of the border.
Let's talk about some of the longs. What do you like here in Canada?
Well, tying into GICS, pretty interestingly, is a company called Brookfield Property Partners. This is a global manager, one of the best managers creating value over decades in the real estate space. It's a bit of a different animal in that it's not a REIT. It has a structure that is hard for the traditional real estate investor to hold. Why I mention GICS is that with these changes, with the index changes, the TSX 60 is looking for constituents to add. Brookfield Property Partners is a big potential weight to go into that index, and it's a company trading at a 30% discount to net asset value. That's where we start.
Why? Right. So on a valuation perspective, and it is interesting because a lot of the time when we do talk about yields, when we talk about the REITs, but we look at the yield first very often, and that could be a big trap for many people without looking at the valuation. So why is Brookfield trading at a 30% discount to NAV, net asset value?
It's a diversified company. It owns tremendous assets. However, typical real estate investors like single-focused sector companies. So they own office, they own retail, they own multifamily, they own across the gamut, and they own it globally. Difficult for investors to value. The other part of the equation is that it's effectively externally managed by its parent, Brookfield Asset Management. So it gets a discount for that. We look past that discount, we incorporate it in what we think the true value is, but we also see that this company is going to increase value over time. You mentioned some of those REITs. that typically trade off of yield, they're just trying to manufacture a yield. They aren't necessarily creating value. I mentioned Brookfield, they create value.
When you say they manufacture yield, what do you mean?
We have a saying, Bay Street sells yield because yield sells. So what does that mean? A typical REIT might go to the market and say, buy our stock because we trade at a 7 yield. But they obviously have to come up with the cash flow to manufacture that 7 yield. If your cost of capital is 5, then you have to buy cap rates that are higher than a 5, for example. That would force you to go into secondary markets, secondary assets, just to manufacture that yield. But over the long run, that hurts you.
Are there any names out there right now that you think that manufacturing of yield is taking place that you would want to short or sell if you own it?
Well, we've had a short position, for example, in a company called Dream Office REIT for many years now. This has been a call on supply and demand, simply supply and demand. 4 years ago, we looked at the supply picture coming in Canada, several million square feet. And this was long before the price of oil cratered and NDP government came into Alberta, where they have a huge presence. For example, a company like Dream bought assets, went on a big buying spree for many years, and now only years later are we seeing perhaps they didn't buy the assets that could stand the test of time. They've taken $750 million write-down alone this year in their asset base.
Let me just go back to one of your longs that I saw on the screen come up, Chartwell.
Yeah.
Why do you like this one? And this is a single asset or single strategy play, is it not?
So Chartwell is very interesting to us because it's the antithesis of buying yield. Because what are you doing here? You're buying growth. This is in an asset class, retirement residences, where there's a huge demographic play. Your previous guest talked about the demographics in residential. The senior aging population, it's true, it's coming. The baby boomers are now becoming those renters of Chartwell's facilities. They have finally gotten their business to the point where the occupancies justify large rent increases, sustainable rent increases, and so we see great NOI growth. That only increases your value over time, your net asset value.
What's the discount to net asset value? I'm assuming it's at a discount?
We only own things at a discount.
Oh, okay.
So yeah, I mean the stock, for our basis, it's about a 10% discount to NAV, but that doesn't factor into the continual growth that we see over years.
Okay, I think we have to leave it there, Andrew. Just from a timing perspective, I could keep going down the list, but thank you very much for joining us.
Thanks for having me.
Appreciate it. Thank you.